um, so that we can get the video out timely. And I'm just going to jump right in. All right, so lots is happening all over the world, and I'm going to go through the fundamentals real quick. They haven't changed. They're bullish as all get out. In fact, I don't know how much more bullish they can get. Right? Our forecast and our weather's not fantastic. Demand is off the charts good, even for ethanol, right? We started shipping ethanol to China, and they stepped in to start being purchasers of it. So demand is skyrocketing. Our weather's not that great. We have tremendous yield pressure all over the place for us to grow a perfect crop. We have no room for error whatsoever. And now we're watching South America burn up in front of our eyes, which is even more bullish. So you can't get much more of a bullish narrative than that. And what's interesting is that this week, 1 year ago today, we said the exact same thing. So this is the weekly chart of corn that I've got in front of you, and I have it scrolled back to where this is the week of May 4th last year. And I want to just talk a little bit about market psychology here, right? We've been talking about it the last couple weeks. And when things get so tilted one direction, to where even the guys that I read that are just permanently bearish, even this morning, they're turning unbelievably bullish. And anytime you get to these extremes, it should be a round of caution. So 1 year ago, to kind of refresh everybody's memory, 1 year ago, what we had done is we were in puts. At the early 2020, we had said, hey, this doesn't feel great, so we're going to buy puts on new crop corn, and we did. 1 year ago, we came out of those puts. We rolled them down, and we left a cheap, inexpensive put down here, and everyone thought we were completely crazy. And honestly, we thought we were crazy too, because the fundamentals a year ago today were so horrible, right? We had 3+ billion bushel carryouts. We were shutting ethanol down. We had COVID. I mean, there was talk that we have to pull 20 million acres of corn out of production just to keep the price above zero, right? Oil went negative. Grains might go negative. Oh my gosh, we got to run for the exits. And so the mood was overwhelmingly bearish 1 year ago. I'm sure everybody remembers that. I know I sure do. But our indicators were telling us something different. And so what we said a year ago, and I went back and listened to this market chat from a year ago. What we said then was, hey, we're super bearish. We think we're going lower because there's no way corn doesn't go, below $3 with this setup. But we don't think we're going to go lower now because we've got divergences and because we've got a whole growing season ahead of us. And we think that we are bearish, but we have to first pollinate the crop and then we can sell it. And so what ended up happening, right, is we scroll forward and we get into July, we pollinate the crop, and we came back down and tested the lows, and then we're off to the races, and we never look back, right? So we scroll forward to today, and let me resize this chart, right, because we're up almost $4 a bushel from that low on the weekly chart. And so here we are, right? We're at $7.50 on the May contract. We're at $7 on July. I'm going to switch over to that now, and we're screaming higher. South America's burning up. Our fundamentals could not be more bullish, but yet we think that we're ready for a pause here. And I'm going to say the same exact thing that we said a year ago in reverse, which is we're still really bullish corn. I think, hold on, this is beans. It'd be useful if I was talking about the right crop. Here's corn. I think that our 2012 highs are going away, to be perfectly honest. I really do. If we get into any sort of a weather hiccup at all, I don't know where the ceiling is on this thing, but you've all listened for several weeks. We have no room for error in this crop. If we have any yield hit whatsoever, then Katie bar the door, we're going higher. But that doesn't mean that we're going straight there. And we're starting to get lots of indications here that tell us that something is coming, and pressing the long side is really, really risky today. So what I want to do is walk through the price relationships between beans and corn, and then I want to come back to corn, and I want to build out this technical analysis so that you can see exactly what it is that we're looking for, okay? So first, let's talk about Kansas City wheat versus corn. This is your monthly chart. This is comparing May to May today, and it's now at an all-time discount to corn. If I take this out to the daily chart, we're trading penny for penny, July to July, wheat to corn, and so it's an extremely cheap relationship between Kansas City wheat and corn. There's lots of reasons for that, but I would argue that the primary reason is that the corn balance sheet is just way too tight. We've been talking about this. When this move, when wheat collapsed and dropped a buck earlier this year, everyone's like, oh my gosh, we just have too much of it. But that's not what was happening. The market was rationing corn early on. It was the wheat market did the first major heavy lifting, right? And so it put itself into the feed ration, and we're feeding it. For the first time in my career, I had customers getting cold called by feedlots trying to buy wheat for June, July delivery. I've never had that happen before, and it was eye-opening because the feedlots are also seeing the spread, right? They want to own it. The other thing that's happening in the second piece is the bean-corn relationship. So you hear corn referred to as king corn all the time, right? Where and what that means is we know here in the U.S. that we have the ability to grow corn better than anybody else on the planet. We have kind of the perfect situation of soils, longitude, latitude, elevations, and there's no secret that we are where the world comes to for corn development, right? And so when corn gets into a situation like it's in, it has to rear its head up and it has to charge away and kind of put every other market in its place, right? Including wheat and including beans. So we saw this corn bean spread just completely implode and collapse and skew the economics way in favor of corn planting, which it has done. I mean, the numbers, we were running numbers last week, and there's like a $200 an acre swing, depending where you're at, in favor of corn economics. So I think corn is buying acres, and I think it has to just to hold serve. Otherwise, I think that we are, we run the risk of the balance sheet just flat out getting too tight. So corn has taken off and run. The market's put wheat into the feed ration to help ration corn. It's put this spread in its place in order to buy the acres, effectively telling the world, hey world, we're going to focus on corn. South America, we're going to punt soybeans to you, and that's going to be your problem, in your next cycle, provided that weather's good. And so that's kind of what the market has been doing. And so when we look at December corn, though, I'm going to take some of these indicators off because I want to rebuild them with you. Those of you that have traded with me for a long time know that I really like the cloud and that we really, really like and are aware of divergences. And what we're looking for in technical analysis is confirmation, right? When we're bullish, we want to see buyers come into the market and flood into it and buy up with big volume, and we want them to go crazy for it. And that has happened all the way from August up until now. We're clearly bullish. We're in an uptrend. There's nothing to worry about. But now I'm going to start laying on different indicators for you because we made some adjustments this week, and I want to show you why. I went home Friday thinking, hey, we're going to blow up out of here and never another bad day. But on Monday, I really did not like this trade action at all. And so we moved into hedge positions because we came out of all of our longs, we came out of all of our specs, and we moved to hedging because of this. All right. So I'm going to start with this indicator. Those of you that have seen this before, I usually have it on the chart. It's really, really useful about 3 or 4 times a year. Otherwise, it's just kind of there. But what this is telling us is that this move is getting extremely worn out. As you can see, as we've started to move higher, our histogram down here, the distance between these two lines is beginning to shrink as we're breaking out to new highs. This is called a divergence, right? And so the first thing that we look for is a disconnect between strength and not. Last week, we had no divergences on this chart whatsoever. I'm going to keep adding. Here's my force index. It's one of my favorite indicators. This is a divergence. We're breaking out to new highs. We have no follow through with momentum. Here's our RSI, very, very popular indicator. Divergence. We're breaking out to new highs. We have lower confirmation here. Stochastics. Divergence. All the way across. I can keep going and add different indicators all over the place here. But the reality is that last week on this big reversal, we had no divergences. Everything here was at their highs. This week, we recognize that we have new divergences. So the market's telling us something different, that there's less conviction behind this rally than there has been. And then the last indicator that we really like is TD sequential, which is has a sell countdown. Now, these sell countdowns are very, very powerful, but in these steep uptrends, we've been ignoring them, and we've gotten 7 of them now. This one I feel like is more powerful that we're getting today because it's accompanied by divergences across everything else. And so what this is telling us is that the downside risk of corn today is greater than the upside potential. Because if we just charge higher, then these indicators will just get so overwhelmingly overbought that eventually they will snap back to their means. And when we see a divergence between momentum and strength and underlying conviction, coupled with a sell down, with a completed sell countdown with this indicator, history would tell us that it's time to be defensive. So on Monday, what we did is exited all long calls, and we've been long since October, right? So we exited all long positions and went into hedge positions. And what we recommended, and I still recommend, is taking a portion of your risk and moving it to the sideline. I like doing some in an HTA or a futures lock. I like buying at the money puts and selling a 640 or 650 call on a portion of your production. So now if you're you got to be kind of careful with the short call here because we can explode up out of here and test it. But the reason that we chose 640 short calls is because we saw this 13 coming. This was an 11, so it's not that hard to get to a 13 from here. And we did the math and knew that the 13 countdown was valid below 633. So we sold 640 calls against it and bought puts. Now, where do I think that we're going to go to? Let me take some of these. Let me clean this up a little bit and take these indicators down. I think that the most probable target that we're going to get back to is a 61.8% retracement. The reason I believe that that's the target is because the prior moves have really retraced 38.2%. So you can see we got there last week on a 38.2%. We've bought it. Now we've diverged. So I think that when we sell back off, we're going to come to a 50 or even a 61.8% retracement, which is all the way back down here at $5. Now, I can hear everybody's thoughts. No way, dude. You're crazy. Can't happen. Brazil's burning up. I know. I get it. Wholeheartedly understand it. But guys, we rallied corn last year from $3 to $3.60 in a couple of weeks with the threat of 6 billion bushels of with ethanol plants shutting down and 6 billion bushels of demand getting killed right before our eyes. We still rallied the market for no reason whatsoever. And that was with no volatility, and that was with nobody really cared about corn at this point. Now we've got massive money flow, and we've got expanded limits, and we've got higher volumes and higher volatility than we've had. So a move to the downside is going to be exacerbated. You saw that here, right, where we moved from 593 all the way down to 563, 40 cents in a day and a half, and now we're right back up. So to think that we can't pop down to here real quick, say hello, and then rally again, I don't believe it. Right? We certainly can, and it'll do it if it catches the most people that it can off guard, which is where I think that we're at, because every indicator we look at is diverging. Every indicator and system that we have is extremely overbought. And I went back and looked as far back as I could get, and we've never had a setup where corn is as overbought as it is. So just look at the evidence, right? You've got divergences all over this map. You've got your relationships between two critical commodities, corn and beans, at extreme moves and at extreme values in an extreme situation. And then the last thing that really threw me over the edge Monday morning was, do you see how we've rallied December corn here, but we have not yet broken out of this high? Well, July corn didn't do that. July corn broke up out of its high on Monday. So now you have an intermarket divergence as well, where December has diverged against July. So when you add all of that up, that screams to me we have downside risk. And so Friday, my thought was we're going to roll our calls up, we're going to keep some length, but we're going to start being more conservative on the way up. On Monday, it completely changed my mind and said, no, we have to be hedged because the downside is too much. Now, I think we're going to take a dip, and then I think we're going to come right back up, especially if we have any kind of a weather issue at all. But I think our dip could be extreme enough that it makes sense to be hedged. So understand, I'm not recommending specs. I'm not recommending any of that. But I do think that production risk we've got to maintain, because our number one job is to not mess it up, right? We don't want to let a big profit turn into something smaller. So if you take half your production and you buy at the money puts, or buy at the money puts on all of it, it doesn't matter, and sell half your production with a call at 640, your worst case scenario is that corn goes to $8 and you've sold half your production at 640 and you still own your other half. This is not a tragedy. The other scenario is we break from here and we get down into this level, and we're going to lift those hedges, and we're going to have banked a lot of money on the downside, and then we can make some decisions as to whether we want to move into cash sales or if we want to move into some long positions at that point. But today, with everything that we look at and everything that we see, this market is screaming that there is downside risk, and it's screaming it at a time when the fundamentals are telling us the exact opposite. I get that wholeheartedly, and it's deja vu all over again from a year ago when we were in the exact same situation, and that was the bottom 1 year ago. So I don't think that we're bottoming. That's not what I'm saying. I think that we have huge downside risk. Beans, I think they're in the same boat. I think soybeans are not as prevalent or as pronounced as their divergence. But remember, this soybean spread, the corn bean spread, it's crashing while beans are at a high, which is fascinating to me. So when these things correct, you can break beans $1 or 75 cents and still correct that spread back to where it may favor beans. Wheat, you can do the same thing with wheat. You can hold wheat or even break it a little bit and rally it relative to corn. So just because wheat's oversold in the feed ration doesn't necessarily mean that it's got to go higher right away. It can correct itself and move lower. So I'm not bearish wheat, but I'm nervous about it if corn breaks. I think it's going to come down with it, and then I think we got to reset and move higher. So the next couple of weeks, until these divergences wrap themselves up and kind of clean themselves up, we're screaming caution. I think we got to be hedged. I think we got to be a little bit conservative here, and then once the market sort of ferrets that condition out of itself, then I think we'll reevaluate and probably get back long. All right, I hope that's not too much of a Debbie Downer, but I do want to tell you, hey, our job is to change our mind when the market tells us to. And from last week to this week, we got the signals that we've been looking for and that we knew would eventually come. And so it is what it is. We gotta go with it to defend our positions. So I hope that's helpful to everybody. Please call me if you have any questions. We're always available and happy to help you work through any issues that you got. I will talk to you next week. Thank you.